is about chart patterns and their interpretations. Now, chart patterns fall in a category called technical analysis. And as we all know, there's two fields of study when you're dealing with the financial markets, and that's technical analysis and fundamental analysis. Technical analysis is basically anything and everything done on a chart. And charting refers to the technical analysis that is performed through careful inspection of an asset's price and data for identification of well-known patterns that emerge in prices, for example, head and shoulders, triangles, channels, and wedges. Now, the field of technical analysis is very, very large. And a lot of people think technical analysis is all about MACD and RSI and stochastics, oscillators, and indicators. But anything you do on a chart is in that area of technical analysis. And there are a part of the field that is actually done physically on the chart, like support and resistance levels, moving averages, and chart patterns, where others are done below the chart. Now, chart patterns are well-documented technical analysis literature and are based on the psychological phenomena that occur between the buyers and the sellers of financial instruments in liquid markets. Pattern formation do not form actually a trading system, but rather provide an indication of the future trend of a share or a price of an asset as the price breaks key psychological barriers in the form of support and resistance lines. Now, there are many, many, many different kinds of chart patterns, and there's all types of gurus out there pushing their own thing. I've seen flying saucers. I've seen teacups. I've seen coffee cups. I've seen half pots. I mean, you name it. But the most popular and most well-documented ones, are triangles, channels, wedges, and head and shoulders. And sometimes we refer to these patterns also, or we have patterns that are called flags and pennants. All of these are well-documented historic patterns that repeat over and over and aren't a guru's interpretation of being able to see something in a price chart. Now, the absolute most popular of these is called triangles. And triangles is formed between converging support and resistance lines. A negative sloping resistance line indicates a reducing level of profit taking, or more certainly about the value of an asset. With a positive sloping support line, the prices are being squeezed into a corner. And ultimately, most everything about candlesticks is exactly that. Price is coming into this apex, this corner. And whether you're dealing with a symmetrical triangle, ascending triangle, or a descending triangle, ultimately, price is being pushed into this corner, and sooner or later, price has to break out. And triangles don't give us many directional clues. They just tell us to be ready for a breakout, and that breakout can be break up or a breakdown. But once price breaks out, there are certain formulas that we can apply to figure out how far or how much that momentum should take it, where to put our stop loss, where to put our take profit, and how to trade with these triangles. So like we said, we have ascending and descending. And these are various specific variations of triangles that can occur, namely ascending and descending. The ascending triangle has a horizontal line, and a descending triangle has a horizontal support line. But ultimately, they mostly take place here. You can see the names because a descending triangle, usually, not always, but usually takes place in a downtrend because you have a horizontal support line and a descending resistance line. A ascending triangle usually appears in an uptrend, and then a symmetrical triangle can happen in either place. But ultimately, price is being pushed into this center wedge. So I'm going to share a presentation I saved for you so that you can see a little bit better graphic presentation. And then we're going to look at some charts to see triangles actually forming in live charts. Okay, so that's the basics I'm trying. Now, I forgot to mention earlier, if you notice on your screen, there are two handouts that I prepared for you. These handouts are only available in this class. In other words, you can't get them anywhere else, and in the recorded version, you can't download them. Now, a guide to chart patterns covers everything we talk about in class and gives you more in specific chart formats and explanations. So you can see it on your screen. Just click the download button and download it to whatever device you're attending class with tonight, and then you can move it to wherever you want. Also, the Introduction from Technical Analysis, which is a very nice book prepared by investing.com, and it will go over all types of the different types of technical analysis and emphasizes all the chart patterns and how to understand what a support and resistance line are and how to draw these. So please click those download buttons so that you have these at your leisure whenever you want. Now, besides a triangle, and triangles, like I said, are the most important, we go to rectangles and channels. Now, a channel is formed between two parallel support and resistance lines. This pattern usually indicates a relatively strong trend, either up or down, with the price staying within the lines until a breakout. So let me show you, like I said, I have some charts ready. So let me pop those up on our screen. So what we're looking at right now is a chart on Bitcoin. These are not trading recommendations or suggestions. I'm just showing you where we can see chart patterns. And we can see in here the development of the triangle. And we have a symmetrical triangle forming. And I'm going to show, I've done a presentation, which I'll share with you in a few minutes. Also, this is going to show you exactly how to draw these step by step. Because a lot of people don't understand is actually how you draw them and find them on your charts. Now, we also happen to have in this chart another chart pattern, which is, you hear about it often, but you don't see it that often. And this is what we're seeing here is an inverse head and shoulders. A head and shoulders is a pattern that's telling us the market's about to reverse, but it's just like a person. It's a shoulder, a head, and a shoulder with a neckline coming across, and the shoulders are fairly equal height. So one will appear in an uptrend and be reversing to a downtrend, and the other appears in a downtrend, which will be then moving into an uptrend. And in this case, we have an inverted head and shoulders, which means it's upside down because we're coming off of the downtrend. So you have the shoulder form, then the head form, and then the right shoulder form. And what we're looking for is it price to can now continue this way and break out of finish that final formation of shoulder and break up this direction. Okay. So we'll expect this as this pattern gets a little bit closer here. But it's very unusual to actually have two patterns within, within each other. But it does happen. Now here we have a beautiful channel formation. Downtrend, beautifully done. Okay. We can see the channel going down, and then we see the breakout right here. And there is a way to measure this momentum to figure out where the price will break to and what momentum should carry to and where to put your stop loss. But we can see this would have been our buy level when it broke out, and it would have been above the high of the previous candle. And so you have to add some technique and some knowledge of how you would trade with them. But you see this beautiful channel formation. So what we would have been waiting for is the candle to break out of that channel. And then lastly, we have a beautiful triangle formation. Here on the euro US dollar, as it's moving into the apex, as it's building up that pent up demand. And here we're hoping for a breakout to push it up to its key support level, break back down, and then hopefully break out. This is only predictions of what we would like to see happen. But see, we'll buy if it breaks above the 114.02 level. Okay, again, this is not a trading recommendation. The prices have probably moved on farther since then. Okay, but this is how you would see a triangle and what you would use it on your charts. So let me pop up a presentation for you, and you'll show you how to use these trend lines or how to draw these lines to find the chart patterns. And then we're going to go on and talk about some other chart patterns, and we'll talk about head and shoulders in more in detail, and we'll talk about double tops and triple tops and double bottoms. So as you saw in the presentation, okay, just drawing those support and resistance lines or those trend lines aren't so difficult, but it's a matter of spotting these patterns takes a little bit of time and a little bit of idea and understanding and a little bit of knowledge, but it's not very difficult. But now there we saw, especially the last triangle, and the reason we're talking about 3 weeks is because we were looking at a weekly chart, but you can figure out the time in which the maximum time before you're going to get a breakout, because it will break out by the time it hits the center of that triangle. But it will break out. Possibly it can break out before it gets to the center. But you know what, it will happen no later than that time. So if you're using a 15-minute chart and instead of a weekly chart, it's going to do the same thing, and you can judge. It'll be an hour and a half from now it's going to break out, or it'll break out by tomorrow. Okay. Now the key to look for that we haven't mentioned is volume. Okay, and we'll talk about that shortly, but volume will give you the clue to whether you actually got a real breakout, because sometimes price will test those lines and bounce above it for a second and move right back in to go back towards that apex. So volume will tell you whether you have a true breakout. Again, break up or break down, okay, it's just depending on whether it breaks going up or going down, but we don't know. Now, we also referred in that presentation a lot to bull flags and bull pennants. Okay, these occur, and a lot of people use flags and pennants more than they do rectangles and channels. So rectangles and channels are sometimes called flags and pennants, depending on the slope of the initial trend and the slope of the breakout. A flag would be defined as a bullish continuation channel down, or a bearish continuation channel up. A pennant would be defined as a bullish continuation triangle or a bearish continuation triangle. Then we also go on to wedges. Now, I find it quite difficult to define between a wedge and a triangle. And to be honest with you, you don't really need to. You don't have to remember what all of these patterns are called. You just have to see them develop and know how to interpret them. Wedges are similar to triangles in that these patterns are formed between converging support and resistance lines. However, where the support and resistance lines in a triangle have one positive slope and one negative slope, the support and resistance lines in a wedge have both either a positive or a negative. So in other words, on the little chart on the right-hand side, oops, just lost my little chart here. So on the chart, we can see that neither one is straight. They're both sloping. Now, in this case, because we have a wedge continuation, they're both sloping up. So that means they're moving at separate speeds, but both angular upward. And they'll eventually come together as a triangle, but because they're sloping, both are sloping, they'll come together, and they'll eventually form a triangle, but it's a triangle that's more like a wedge. And a reversal wedge means they're both sloping downward, where a continuation wedge means they're both sloping upward. So it gets very complicated or time consuming or difficult to notice all these patterns, because it means you can have a trend line sideways, you can have a trend line sloping, you have a trend line sloping down, trend line, a support line sloping up or down, and they get a wee bit confusing because it says, you sound yourself, well, I can always find lines sloping this way, going that way, channeling this way. Okay, so it becomes a little bit of a science identifying these. Now, the most common wedges are found as breakouts in the opposite direction of a wedge. That is, bearish breakouts in a rising wedge and bullish breakouts in a falling wedge. So in other words, when we have a rising wedge or a continuation wedge, we would break out down. Okay, in a falling wedge, we would expect to break out upward. Now, this is only a percentage that it breaks out or this is what can be expected. But it doesn't mean that it can't continue down or break out going down. But we would expect it to break out in the opposite direction of the wedge. Now, before we go on head and shoulders, let's talk about how we would figure out where to put our exit points and our entry points and how to trade from these triangles. So that shows you how you might want to use the symmetry of the triangle. And it's basically the width of the opening of the backside of the triangle. And I know in algebra or something, they taught us what that width was called, but I don't remember what it is anymore. And using that and the breakout points in the high and lows to figure your stop loss and take profit point. And this is a standard method. This is not a customized method. This isn't our unique method. This is what is standard. In fact, if you go to the internet and just do a search for chart patterns, you're going to find all kinds of charts with exactly this. And they'll show you the entry level, the exit level, where to put it, because this is what's used overall by the markets once you've identified it, and it works more than it fails. Now, once we move away from triangles, one of the world's most renowned trading patterns is the head and shoulders, which we looked at on a chart. We're going to go back and look at it again in a minute. But a head and shoulders is a true reversal pattern. And it's kind of unique because it looks like the head and shoulders of a human being, a person. We have price will be coming in and moving to form the left shoulder. This takes a long time to form the entire pattern. And you're not going to notice it when the left shoulder forms. You're not going to notice it till the head forms. You're not going to notice it until it's all the way over here. So it's not something you have to catch in the very beginning. And it also leaves you more than enough time to set up your trade or make your trading decision. But price is going to move up and hit a support level or resistance level, and it's going to bounce back off of there. It's going to come down to the support level and bounce off of there. It's going to come back up and hit a higher resistance level. Okay. Bounce back and come down to the same previous support level. Now, this forms what's called the neckline. It's then going to bounce off that neckline and come up to this previous resistance level and bounce off of it. Okay. And then come back down and break that neckline. When it breaks that neckline here, that's where it gives you the entry point. But before we get to there, we have a lot of talk to talk about. There's all kinds of rules and regulations that different market specialists are going to tell you about. The head and the shoulders have to be equal length. The head has to be so much above the shoulders. Okay. My explanation to you is a head and shoulders of a human being. Some of us have big, broad shoulders and a short neck and a low head. Others of us are slunched over to the left side or the right side. And so one shoulder's not as high as the other. We droop down. Some of us are old, so our shoulders are rounded. Okay. The fact is, it's open to interpretation. What is important is the formation of the neckline here, and that you have two shoulders that are pretty close off of the same resistance level and a head that peaks out in between. Okay. And the head, like I said, some people have long necks, some people have short legs, some people have high forehead, some people don't. Okay. But as long as the head is above the shoulders, okay, it forms the head and shoulders. Like I said, there's all types of equations that people have out there. But the fact is, I firmly believe that as long as it forms this pattern, what the actual interpretation is, we have gurus out there saying, well, if the head is 22% higher than the shoulders, then the breakout should be 27%. Don't get lost in it. This is somebody teaching their own little system. Because the popular head and shoulders pattern is essentially a triple top pattern, except instead of all the peaks hitting the same resistance level, the head peaks slightly higher than the shoulders. Ultimately, what's important is the formation of that neckline. Okay. Now, investors have specific beliefs about the amount of bearish fallback that should occur between the tops. Some allowing for 10% loss between the price returns to test the resistance level again, some requiring 15. Regardless of the views, these patterns are very popular among traders and analysts, and they predict trend reversals with reliability. Signal strength is bolstered always by other indicators such as waning volume or a trend that's near exhaustion. So as you can see in this little chart that I popped up here, and I'll go back and you'll see how this one looks very close to the live chart that I had up here. Actually, let's go to the live chart. Okay. Now, the three turquoise lines here are indicating the formation of the inverse head and shoulder because it's forming from a downtrend. Okay. And so therefore it's upside down. And as you can see, if you start applying all those rules that somebody gives you, some guru, you'll never find these, because when you're dealing with trading, it's not so clear cut as it is on a little graphic depiction. But the fact is, here we have the formation of the left shoulder, the head that's farther down, the right shoulder, okay? And we have exactly that. We have basically, this is a triple bottom, okay? Except the center bottom went lower than the two previous bottoms. And again, like I said before, it's very rare to find this within another triangle. We have like I said, we have another pattern. We actually have the triangle formation. So what we're expecting is, from the triangle, we're expecting the breakdown. And we need to figure out now, because we have two patterns, which is going to be the dominant pattern. But we do have the formation of the two. So we have the inverse head and shoulders forming from the downtrend, and because of the reversal pattern, we have a more likelihood that we're going to move into a breakout upward. Oh. Now, to calculate, and when you saw the video presentation on where to put your stop loss, your take profit, how to figure out where your target and your range were, there are simple calculations. So like for a head and shoulders is T, which is your target point where you expect the price to go, is equal to the neckline, whatever price that neckline forms on, minus the head minus the neck. So it's this price minus this minus that. And if you were to put them in the formula and drop them in, it would give you the target price that you would expect your asset to go. Your sell signal would be generated as soon as it breaks the formation of the right shoulder, and then it breaks below the neckline, gives you your sell, because you're entering a short position here, and your target price would have been here. Even though the price continued down lower, this would have been your target, because you have to have a target price in order to do your stop loss and take profit points. Now, all of this is explained to you in that handout I gave you, and that's why it's important that you download that handout. Now, there's two other popular types of patterns, and these are tops and bottoms. Okay, I pay virtually no attention to double tops and double bottoms. If you were in investing and you were looking at longer term movements in slower moving markets, especially stocks, a double top and a double bottom might have some significance. But we're all here because we're CFD and Forex traders, basically. And these patterns happen very, 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 very often in Forex and CFD because we're looking at short term, and price reaches up a support level, bounces off, goes back to that support level, bounces off. But it's really less about trade. It's just about the average movement of the price. So for this to happen twice means price moves up, hits a support level, bounces back down, comes to hits a resistance level, comes down to the support level, bounces back up, comes down. It's anybody's guess what's going to happen at that point, because a double top is just 2 points. Okay, double bottom's exactly the opposite. But when we come to the next level, a triple top and a triple bottom, we get some more reliability. So in other words, when price is moving up and it comes up here, and hits a resistance level, falls back down to the support level, goes back up and hits that same resistance level, falls back to that support level and moves back up. So what's happened is tried to break this price 3 times and has been unable to, and then it falls back down and it breaks below that support line. That's telling you have a true reversal, and that gives you a very strong entry point. A triple bottom is the exact opposite. Okay. So triple tops and triple bottoms are reversal patterns that touch either the support or resistance line 3 times before reversing their trend. This is a stronger indicator of a trend change in a double top or double bottom. So look for the strong initial pattern and a significant breakout in order to confirm. Remember, use other indicators to make your final decision, especially volume. So a triple top is a price pattern which is formed in an uptrend and is followed by a drop in prices. A triple bottom is a price pattern that is formed in a downtrend and is followed by a rise in prices. Now, always keep in mind that trends and breakouts are important. The more well-developed the trend is, or the harder the trend is, the more likely or the more momentum that breakout's going to have. Because you can have an uptrend or a downtrend. It's a sloppy trend, just moving, not sideways, but just kind of moving slowly downward and just all over the place, like you see in the right-hand picture. And it still works well with patterns. But when you get a breakout, it's the breakout's reliable, but will it have the momentum to carry it forward because it's been a sloppy trend? When you have a well-developed trend and a pattern falling within a well-developed trend, it's important. So an important measure of the quality of the pattern is the trend that precedes it. It doesn't matter whether the trend is bullish or bearish, but the consistency and the duration of the initial trend partly determines the well-formedness of the pattern. So a pattern is simply said to have broken out once it has crossed either the support or the resistance line. If the pattern broke out in the same direction as the preceding trend, it is called a continuation pattern. If breakout is in the opposite direction, it is called a reversal pattern. For example, a pattern described as a bullish reversal triangle. Okay. Bullish reversal triangle would mean that it is a bullish signal. Now that is, the breakout was through the resistance line upward. Because it's a reversal pattern, that means that the preceding pattern, the trend, was in the opposite direction of the breakout, or that it had been a bearish trend. Okay, now, these are the simple formulas that are used for calculating these. They're not very complicated. And you can get your stop loss, your take profit, and your entry point simply from the patterns. Again, this is not something I made up. This is not my secret weapon. This is standard throughout the market. And you can see when each one of these are designed, and they're all based on this distance of between the uptrend and the downtrend line, or the support and resistance, with your stop loss being slightly above, your entry level being when it broke through, and your target point being the difference between this movement. Okay. And this is in your guide that I've handed out. You can also find it all over the internet because, like I said, it's not unique. This is the standard interpretation of these patterns. And on that note, I'm going to say goodnight to everybody. Please, before I sign off for everybody, please, if you haven't clicked those download buttons, click those download buttons now. Because as I said, in the recorded version, you will not be able to download anything. And hold on to those. Thank you very much for joining us. Have a great trading week. And if you have any questions, Trade Times Education Center gives you lots and lots of information. Have a good night now. And again, thank you for joining us.